Good morning, guys. Happy Monday, happy spring. I just want to do a couple things today. I want to make sure everything's set up here. Great. Sound goes. Okay. So we left last week with a fully balanced balance sheet. And I just want to recap what we did, how we did it, because it's going to highlight some techniques for making sure you always have a good balanced balance sheet, because balancing a balance sheet is something that keeps analysts up all night. And there's a couple things I want to point out. If you build a model right, if you build the model in a way where the formula is clean, you should always have a balancing model, and it should balance completely. I've seen, and I ran through this quickly at the end of last class, I've seen sometimes a model that says doesn't balance, but the numbers look quite similar, like 271094.9, 271094.8. And then somebody says, even when I was in banking, I heard this. Oh, it's a rounding error. No, there's no such thing. It's got, if it's off by 0.1, it's not balancing. There's something wrong. Now, it might not make a difference to your overall analysis evaluation, but for your own purposes, and if you are looking to balance balance a model for an interview preparation or something, you need to find every piece, every reason why your model might be out of balance. So that being said, I want to recap how we built this balance sheet and make sure you can step back and think about it, because that's step one to really understanding how models stay in balance, which is step one for really understanding how to solve an unbalanced balance sheet. Okay, so remember, when building a model where the cash flow drives the balance sheet, you're really building a model that's less susceptible to error. Although I recognize there are models where the balance sheet drives the cash flow statement, and I do recognize there are some industries like private equity where sometimes you have to do it that way because the companies you're working with present you with an income statement and a balance sheet and not a cash flow statement. So you have to go that way. But if you have a choice, we have a choice here because we have a public company that has all three statements. If you have a choice, it is better to start with the cash flow driving the balance sheet. Why? Because going the other way, you're basically plugging. You're solving for an unknown. Here, if you have a cash flow statement, the cash flow, we talked about this when we started opening up the concept of cash flow statement. They say they have this concept, cash is king. That's true in a lot of different facets. It's true when thinking about a cash flow statement, because you would assume a cash flow is one of the most accurate statements that's out there because it's actually matching your cash inflows and outflows from your bank account. So we're taking each and every cash flow, which is really accurate, and using it to drive an asset, liability, and shareholder equity. So we're taking each cash flow and asking ourselves two questions. One, which line item in the balance sheet is impacted by this cash flow line item? And two, in what direction? Because we know two things now from what we learned last class. We know, one, if this cash flow statement will drive an asset, it'll be an inverted relationship, meaning if cash is up, if it's a cash inflow, the asset will go down. If it's a cash outflow, the asset will go up. And two, if this cash flow will drive a liability or shareholder equity, there's a direct relationship. In other words, if the cash is going up, then your liability or shareholder equity is going up. Or if your cash is going down, then your liability or shareholder's equity is going down. And so that's why one of the biggest and most important steps in understanding and making sure that your balance sheet will balance when you build it is to make sure your structure and formula is laid out in such a way where this logic still holds. So in other words, for assets, it's balance sheet item today, or the projected balance sheet item, I should say next year, equals last year's balance sheet item minus the cash flow item for assets, minus, because of the inverted relationship between balance sheet and cash. We took accounts receivable, for example, right? If there's an accounts receivable inflow in your cash flow statement, that means you've collected on your receivables. You've collected what was owed from your customer. If you've collected, then your accounts receivable balance will go down. So your balance sheet balance should say balance sheet last year minus that positive cash flow. For liabilities or shareholders' equity, it's a plus. So for liabilities and shareholders' equity, the balance sheet formula is balance sheet item, the projected balance sheet item equals last year's plus the liability or shareholder equity change, plus the cash flow. You can think about debt, for example. If you were to borrow debt, you'd get money. You'd also get a liability. So if you were to borrow debt and there's a cash positive line item in your cash and financing operations, this means you've received money, which means you've borrowed money, which means you've increased the liability. So the projected year's liability will equal last year's liability plus the cash change. Conversely, if you were to pay down that debt, let's say you have money now, you would pay down that debt, you'd see a negative flow in the cash flow statement and the liability would go down. So next year's cash flow statement, next year's projected balance sheet line item plus the cash flow statement line item, but your cash flow statement line item will be negative. So having this structure and formula is key to making sure your balance sheet's in balance. And if you think about the way a balance sheet stays in balance, a balance sheet stays in balance when each and every cash flow statement line item is linked into the balance sheet one time, and in the right direction. That's how a balance sheet stays in balance. No other way a balance sheet, well, there's one other way a balance sheet can be out of balance. I'll talk about that in a second. But the second step is to ensure that you have utilized each and every cash flow statement line item once and only one time. Why? Because there are 4 possible balance sheet balancing errors. 1, there's a line item in the cash flow statement that you left out. You didn't link it to the balance sheet. You left it out. That would cause a balance sheet imbalance. You just didn't, there's a value in the cash flow statement not linked to the balance sheet. Your balance sheet's not going to balance. 2, there's a line item in the cash flow statement that's been linked into 2 separate places. You used it twice accidentally. That happens a lot. You see something like other assets, and you link it in to other current assets, and then you link it into other long-term assets. I don't know. So this is why you have to just make sure you're marking off each cash flow statement line item as you use it. If you noticed in the last class, that's what I did. I highlighted it yellow. 3, there's a line item in the cash flow statement that's been linked to the balance sheet, but it's going the wrong way. Now, this is where it's so important that you use this formula structure, the pluses and the minuses, right? Or maybe it's going the right way, but it's linked to the wrong column. Again, structure and formula. So what I like to do, if you're building a model, and if you built the model with a similar structure and formula, I can quickly scan and say, all right, well, my formula always wants to start with equals column F, equals F8, equals F9, right? Because I'm starting equals the column before, plus or minus the cash flow change. And the cash flow column I'm looking at is column G, 2020. So what I quickly do if my model doesn't balance is I first make sure my first term in my formula is F, 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 F. And for all assets, I want to make sure in between it's minus, 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 minus. And then minus what? Cash flow statement G, 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 G. If something's wrong, if this is H, or if this is H, or if this is E, then that's a problem. If this is a plus when it should be a minus, that's a problem. And then finally, I mentioned that there is another way, and this actually happened to us. There's another way you might have an imbalance. And this is where sometimes a lot of people say, oh, it's a rounding error, when it's not. There is a totaling error in your cash flow statement, easily missed. For example, I add up total change in cash and cash equivalents, and that formula is wrong. I'm adding, let's say, not 63, I'm adding 8. This is a mistake that's commonly happening. This isn't a proper total. My total is wrong. Or if you didn't notice what was wrong last time, this is such a common error. I have a percentage in here. This percentage should not belong in my total. This percentage is just used to project CapEx. But oftentimes, an analyst working quickly would do an all equals sum formula, would total everything up, and would accidentally include my projection metric into my total. So I'm going to be off by 6%. Look at my balance sheet. I'm off. Look, 094.9, 094.9. You can't even see the difference. It's a decimal. And I would likely hear in this situation, oh, it's a rounding error. No, something's wrong. Never rounding. Guess what? I'm accidentally including 0.06006, sorry, into my total. Let me fix that. This is foolproof. Okay, there is a foolproof method. If you follow this, I promise you, you will never not have an unbalanced balance sheet. There is a foolproof method, and I'm not going to go into complete detail. Check on YouTube. I have solving unbalanced balance sheets, several videos where I give examples, I give homework examples, dig into that stuff. But I'm going to give you a quick overview because it's so important. What I recommend, now knowing why a balance sheet could be out of balance. This is the only reason why. If you think about the concept of how a balance sheet stays in balance, is you have a total cash flow line item, and each individual line item that makes up that total must drive your balance sheet in some way. Then the only way something can go wrong is if, I'm going to recap, there's a line item in the cash flow statement you forgot to link in. There's a line item in the cash flow statement you've used twice accidentally. Your signs are going the wrong way, or you're linking the wrong column, or your total is wrong. And so what I like to do to make sure I can check all this and to make sure my balance sheet is always in balance, if my balance sheet doesn't balance, what I do is let's go back to the case. Let's say my balance sheet doesn't balance here. Here we go. Boom. Balance, no. Okay. What I would like to do, what I usually do is I delete everything here. I'm not going to get distracted. I make a differences column. Okay. And I subtract. These are my differences. Whoops. Okay. These are my differences. Here we go. All the way down. These differences should reflect cash flow changes. This is going to help me isolate and identify which line items I've either left out of the cash flow statement, used twice in the cash flow statement, or which line items, which values I've missed which formulas I've miscalculated. In other words, I've linked from the wrong column or I've used the wrong sign. Okay. How do I do this? Now, once I have a differences column, I go line by line down each difference, and I ask myself the same two questions I asked myself when building the model. Number one, does this match the appropriate line item, cash flow line item? And number two, is it going the right way? So for example, I know cash and cash equivalents should be driven from cash. So my total cash should be 42411.5. Is it? Yeah, it is. So I'm going to, number one, cross, very important. You find a way to cross this off. You've used this line item. If you're not crossing it off, then you're not proving that you've used every single line item or that you've accidentally use it. You got to be crossing off the line items as you go. Otherwise, you're not going to know that you used every single line item, or you're not going to detect a possible problem that you've accidentally used that line item 2 times. Okay. Next, I want to make sure this is going the right way. So I've generated 42 billion in cash. So my cash balance should be going up, and it is. Done. This is correct. Next, marketable securities is going down by 1140. A reduction in an asset means an increase in cash. I should see a positive 1140 in marketable securities. Where's my marketable securities? Positive 1140. Correct. Done. And the next one. And I go on and on and on. And by the time I get to the bottom of the balance sheet, each cash flow statement line item should be checked off once and only one time. If you've done this whole exercise and you've realized there are cash flow statement line items that haven't been checked off, well, then you've identified a problem type 1, that there's a line item in the cash flow statement that hasn't been linked. If you've gone through the exercise and you've realized a line's been crossed off and you found it being used again, you've detected problem number 2. Line item has been linked in 2 places. If you're going down this exercise and you realize the flows are going the wrong way, so I see a positive 1104 over here, and it should have been negative, or the numbers don't even match. If the numbers don't even match, then I've linked the wrong column. I've linked the wrong years. Both of those issues are problem type 3. Now, it is possible that you've gone down this whole exercise and you're sure you've done it right. You have to cross off. I see so many people say, oh yeah, I crossed it off. They still didn't solve the balance sheet. They haven't crossed things off. They didn't solve the balance sheet. But sometimes you've gone through this, crossed it off, and it's still out of balance. What's happened? Then you found a problem of type 4. There is a totaling. Now you know there's absolutely a totaling error in the cash flow statement. And listen, there's 4 things being totaled here. Very easy at this point to figure that out. Okay? So that's all I'm going to say about solving the balance sheet for this course. But please, there's a lot more online, and we do obviously go a lot more in depth in the in-person courses once we start being able to do those again. Okay, so guess what? Oh, oops. We have a balancing balance sheet. No, we don't. Here we go. My totals again. Okay, we have a balancing balance sheet. We have an income statement. We have a cash flow statement. What's left? The debt schedule. This is the final schedule. This is like the keystone to a pyramid. Holds everything together. Okay, let's talk a little bit about the debt schedule. The purpose of the debt schedule is to maintain your cash balance, your debt balance, and your line of credit or revolving line of credit, interest expense and interest income. If you remember, the final missing pieces in our other statements, we do still have some missing pieces: interest expense, interest income. Where are we? Here we are, interest expense, interest income. And our cash flow statement, short-term debts, long-term debts, principal repayments, finance leases, finance lease obligations. These are missing pieces. The debt schedule is designed to handle that. Why? Because very often in modeling, the debt is managed separately. We want to make sure we're setting up a schedule that tiers down from your short-term debt to your longer-term debts, and that we can use it to manage how we pay down those debts, because quite often the amount of debt we could pay down is based on how much cash we have, and we want to play around with that. We want to have a model that's flexible so that we can run debt scenarios. What if we pay down all our debts? How is that going to impact our net income, taking into account the cash received from interest savings and the tax savings on that? That's complicated. What happens if you want to raise debt? And don't forget, if you raise debt, you're going to have more interest. So there are circular references, you probably hear about this, that link through a model. This one is actually intentional. This circular reference deals with the concept, and we'll introduce it this time, and we'll really get into it in the next class because it's not easy to kind of capture. That when you pay down debt, your debt balance goes down, but your interest goes down. That's an expense. Your expense goes down on your income statement. If your expense goes down, your net income goes up. If your net income goes up, you have more cash. If you have more cash, you could pay down more debt. If you could pay down more debt, your interest reduces further. If your interest reduces further, that goes to the income statement. Your net income increases. If your net income increases, you have a little bit more cash to pay down a little bit more debt, and so on. It is a circular reference. So that's an important key to this schedule. So we're going to get into that. We're going to start to get into just the structure of the debt schedule now. So if you look at it, every debt schedule has a similar structure where at the top, you manage your cash. This is our cash. Then after cash, you have all the debts that we need, all the debts that's been reflected in the balance sheet. So right now we only have two. Okay. Now in the balance sheet, we have long-term debt, long-term lease liabilities. This is our financing obligations and long-term debt. Now, and short-term debt. Okay. Notice in the cash flow statement, we actually have four. We have short-term debt. The short-term debt, guys, if you remember, I put this in as a placeholder. I was very surprised to see that Amazon didn't show any short-term debt. Maybe it's buried somewhere. I've rarely seen a company with long-term debt and without short-term debt. Very funny. It didn't make sense to me. And actually, in the 2020 financials that came out in February, there is short-term debt. So when I build this model for the book, I will have short-term debt. So we're going to continue to build it. Long-term debt borrowings, the finance leases, and finance obligations. So looking at the cash flow statement, there are four pieces of debt we want to build. So I'm going to use this as a guide. So you really want to take a look at the balance sheet and the cash flow statement to say, well, how much debt is out there? I know it sounds confusing, and it's funny that there are only 3 line items in the balance sheet and 4 in the cash flow. And so what's going to happen is we're going to have to create another line item in the balance sheet to match. You want to make sure these match. So what probably has happened for real is this financing obligations is quite minimal. And so they probably buried it into another line item here, but we're not going to do that. We're going to be completely explicit. And we're going to expand the balance sheet to have a line item to match the 4 here. Okay. So we'll do that in a second, but really there are 4 sections we want in the debt schedule. 1 for each line item reflected in the cash flow on the balance sheet, because we want everything to match. We want 1 debt line item for the debt schedule to go into the cash flow, to go into the balance sheet and flow through. We don't want, all right, 4 here, 3 there, 2 there, even though they have that in their model. No, we want to be completely explicit in modeling. Excuse me. In modeling, we want to be completely explicit. So first we have our cash management, then we have our debts, and we're going to expand this to include the 4 debts that we see being reflected. Then we total up a bunch of things. Okay, we'll talk about this when we dig into it deeper. We're going to total our expenses, and then we're going to calculate how much cash are we done after analyzing the debt schedule. Meaning, what if we end up modeling in the debt schedule, issuing and paying down cash and debts and things like that? How much cash do we have at the end of the year? And this cash needs to match the cash on the balance sheet. That's another safety check. So the cash at the end of the year is where we're going to calculate our interest income. If you remember, on the income statement, we're missing interest expense and also interest income. So here at the end of each piece of debt, we have interest expense, which is where we're going to calculate, the interest rate, which is where we're going to calculate interest expense, and cash at the bottom of the year, is where we're going to calculate interest income. So this structure is pretty similar in any debt schedule that I see. Cash analysis at the top, all the debts underneath, and then totals at the bottom. Okay. So the first thing I want to do is I want to make sure all schedules are on the same page. So I want to expand this section into 4. I want to make sure there's 4. We've analyzed between looking at the cash flow on the balance sheet. There are 4 major pieces of debts that the company is looking at. I want to make sure those 4 are explicitly laid out in all these schedules. Okay, so the cash flow statement has the 4: short-term, long-term, finance leases, finance obligations. The balance sheet has short-term, long-term lease liabilities, which are the finance leases, and long-term financing obligations we need to add. So what I'm going to do is I'm going to add a row here to reflect long-term financing obligations. I'll put it under long-term debt. I'm going to go Shift space bar, Control Shift plus, long-term financing obligations. And I'm going to put 0 here, 0 here. Not that it didn't exist, but it was probably buried somewhere else. And if you want to dig out and pull it out, you can. But for what we're doing in the model, it doesn't matter as long as we know it's in the balance sheet. But I want to make sure this links through as we had linked through the other liabilities. So for example, 2020 equals the year before plus payments of financing obligations. Copy to the right. Okay, so we're linking that in from the cash flow statement. The 4, 4, 4, and we want to make sure our debt schedule has 4 sections. So we have 2. We're going to create room for 2 more. Each section has 1, 2, 3, 4, 5, 6, 7 line items. So I'm going to make 14 new spaces. Go Shift space bar. Then I'm going to go Control Shift plus 14 times. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. And I'm going to take this whole section, Shift plus, while holding down Shift, tap down all the way to the bottom here, Control C. Then I'm going to arrow down to row 25 here, Control V, and I'll change the wording here. And then I'm going to go down to line 32, and once again, Control V. So I have my 4 sections here, okay? And so we have short-term debt, long-term debt, we have long-term lease liabilities, okay? And you want to make sure that everything else, when you look at the individual line items within these sections, we have to change the names there too. We'll talk about what they mean, but long-term debt, long-term lease liabilities, bit of a pain, but long-term debt, long-term lease liabilities, long-term lease liabilities, interest rate, long-term lease liabilities, sorry, interest expense, interest rate, okay? And then long-term financing obligations, okay? Long-term financing obligations beginning of year. So what I'm going to do here, obligations, so wordy. I'm going to go, you can only do this within the cell, financing obligations, Control C, long-term, we can only do this in the formula bar up here, debt, Control V, financing obligations, long-term financing obligations, long-term financing obligations, okay? So we are now set up. Okay, we're set up to build the balance sheet. Now, sorry, we're set up to build the debt schedule. How are we on time? Okay. we'll talk about one more concept. I don't want to get started and have to, this is a nice stopping point, but let me talk about one more little piece here. So at the top here, we have cash available to pay down debt. Okay, I want to talk about, sorry. So what we're going to calculate here is, we know how much cash we have on our balance sheet. We know how much cash we have in our bank account. It's on our balance sheet. But how much cash can we use to pay down debt? It's a little different. Why? Well, if you look at the cash flow statement, this change in cash equivalents, $42 billion. This is how much cash we've made in 2020, or we project to make in 2020. Now, if we say, okay, I can use $42 billion to pay down debt, that's not necessarily true. Why? Because this number, look at the total formula, includes the debt pay down. So if I had minus 20 billion in here, I'm going to say, well, I got $22 billion to pay down debt. Well, not really. You might have more. You're taking the cash generated minus the debt pay down. I want to know, how much cash do I have before any debt pay downs? I know it might seem a little, it's hard to think about because this line item hasn't been filled out yet, but let's keep this 20,000 here. Here, let me throw some fake numbers in here to get a better picture. So let's say in 2020, I projected $30 billion to pay down debt. And I want to know, how much cash do I have that I can use to pay down debt? Well, now this number doesn't help me anymore because this number has baked into it the money's used to pay down debt. I want a sum of cash before I pay down debt, but without these numbers. Hence this line item here, cash flow before debt pay down. So what I want to do is, I want to take a calculation of these numbers, right? And I want to not include the cash flow before debt pay down. So I want to sum everything up above again, but exclude the 4 line items related to my debt. That's going to give me a value of how much cash was generated this year without the debt pay downs. And let me tell you, do not take this number and just subtract out. I've seen a lot of people make this mistake. Don't take 12, adding back 20 and 10. You're going to create an unwanted circular reference, and your model is going to bust with all the refs and the values, and you've probably seen that. You will be creating an unwanted circular reference. It's going to cause a lot of errors. You want to just sum from top down every single line item that's not related to debt pay down. So, in other words, cash from operating activities plus cash from investing activities plus each and every individual line item like this. Boom. So I'm excluding, no circular reference here. So even though I have these debt pay downs, I know the cash that I can use to pay down my debt is $42 billion, for example. Okay. Now I'm going to take these numbers out, and these numbers are going to match. So this looks like it's the same number, but now you know it's really very different depending on how it's calculated. This cash flow before debt pay down will be used as a starting point, one of the starting points for our debt schedule. So we have the frame for our debt schedule. Next week, I want to talk about building this completely, linking it into our income statement and cash flow statement. And guess what? We have a complete model. Okay. And just for everyone on here, I think what I'm going to do is I'm going to end the course once we have this model built, because we now are well into a month, 2 months almost of having new numbers. And I'm going to think about a way to rerun the courses. I want to rebuild Amazon with updated models before getting to valuation. I want a better picture of Amazon. I want those 20 numbers in there. I want to think about how to do that. Do I rerun the whole course from scratch? rebuilding the model with the new numbers, or do I just update it on my own on the side, send you the updated model, and then value it? I don't want to value this old model. Because remember what happened was I started these courses in December before they put out their new numbers. Their new numbers paint a very different picture. So I want, after we're done with the debt schedule, I want an updated model before I move forward. So we'll see. I'm going to think about it. Do I rerun the whole course? Maybe I'll just update the model on my own, send it to you. You can build it on your own, and then we'll just continue through valuation. Let me think about that. But next week is going to be a defining point because we'll have built the full model. Took a while, but I appreciate you guys standing by. All right. Thank you for your time, and we'll see you next Monday.